January 30th, 2026 will go down as one of the most violent days in financial market history. Silver plunged 36% in a single trading session. Let me say that again, 36% in one day. Silver crashed from above $121 per ounce to $76 in just 48 hours. That's a $45 per ounce wipeout. If you owned just 10 ounces of silver on Wednesday morning, you watched $450 vanish by Friday afternoon. If you owned 100 ounces, you lost $4,500. If you were a serious investor with 1,000 ounces, you just saw $45,000 evaporate. This wasn't a correction. This wasn't profit taking. This was a complete and total market collapse. COMEX silver futures plunged over 30%, their worst fall since March 1980. The last time silver crashed this hard was when the Hunt brothers tried to corner the market 46 years ago. Back then, regulators had to step in and halt trading to prevent a complete financial system meltdown. And we're seeing the exact same playbook today. The carnage spread across every corner of the precious metals market. On India's multi-commodity exchange, silver March futures crashed Rs 1,6 968 per kilogram, or 27%, to settle at Rs 2,91,925. That's the steepest single-day fall ever recorded for the metal in India. American investors got annihilated even worse. The ProShares Ultra Silver ETF crashed nearly 60% in one session, while the iShares Silver Trust ETF plunged 29%. Both suffered their worst day on record. If you were holding leveraged silver ETFs, you didn't just lose money, you got absolutely destroyed. Your portfolio was cut in half in 6 hours. And here's the terrifying part. This crash didn't happen because of some fundamental change in the silver market. It wasn't a supply glut. It wasn't a collapse in industrial demand. It was a forced liquidation event triggered by margin hikes and algorithmic selling. Translation? The entire rally was built on borrowed money and speculation, and when the house of cards collapsed, it took everyone down with it. To understand why this crash was so devastating, you need to understand the rally that came before it. Silver opened 2025 at $28.90 EU per ounce. By the end of the year, it had surged to over $72 per ounce. That's a 147% gain in 12 months. Silver more than doubled. It was the best performing major asset class of 2025, beating gold, copper, platinum, even the stock market. Investors who bought silver at the beginning of 2025 watched their money nearly triple by year end, and the rally didn't stop in December. Silver kept climbing into January 2026, breaking through $80, then $90, then pushing past $100. By the time it peaked on January 28th at $121 per ounce, silver had surged 215% from where it started in January 2025. What drove this insane rally? Three things. First, industrial demand. Silver is essential for solar panels, electric vehicles, AI data centers, and advanced electronics. Global industrial demand hit 700 million ounces in 2025, a record high. Solar panel manufacturers alone consumed over 25% of annual global silver supply. And with governments around the world pushing green energy mandates, that demand wasn't slowing down. Second, supply deficits. The silver market experienced its fifth consecutive year of supply shortages in 2025. Demand exceeded mine supply by 500 million ounces. That's nearly an entire year of global production missing from the market. Inventories in London, New York, and Shanghai were collapsing. At one point, London's vaults held their lowest silver reserves in years. Traders were paying 200% annualized lease rates just to borrow silver overnight. The physical market was bone dry. Third, safe haven demand. With inflation still elevated, geopolitical tensions rising, and Trump threatening tariffs and trade wars, investors flooded into precious metals. Gold surged past $4,300 per ounce. But silver, as the high volatility cousin of gold, exploded even harder. Investment demand through ETFs hit 200 million ounces in 2025, nearly triple what analysts expected. Everyone wanted silver. Retail investors, institutional funds. Even central banks started accumulating it. The rally looked unstoppable until it wasn't. On January 30th, 2026, at 10:15 a.m. Eastern Time, President Trump posted on Truth Social that he was nominating Kevin Warsh to succeed Jerome Powell as chairman of the Federal Reserve. Within minutes, silver started collapsing. By noon, it had fallen 15%. By market close, it was down 36%. What does a Fed Chair nomination have to do with silver prices? Everything. Kevin Warsh is a former Fed governor who served from 2006 to 2011 during the financial crisis. He's known as an inflation hawk. That means he favors higher interest rates to fight inflation, even if it slows economic growth. During his time at the Fed, Warsh repeatedly warned about runaway inflation that never materialized. He argued the Fed should pull back stimulus, even when unemployment was near 10%. He was wrong then. But markets believe he'll be hawkish now. Here's why that matters. Silver is a monetary metal. It's sensitive to interest rates. When rates are low and the dollar is weak, investors buy silver as an inflation hedge. When rates rise and the dollar strengthens, silver gets crushed. Warsh's nomination signaled to markets that the era of low rates and easy money is over. The Fed was expected to cut rates 3 more times in 2026. Markets were pricing in aggressive easing to support the economy. But with Warsh as the next Fed chair, those rate cuts are off the table. Traders immediately started unwinding their bullish silver positions. But it gets worse. Warsh has also been critical of quantitative easing and the Fed's massive balance sheet. During his previous tenure, he warned that keeping rates too low for too long would fuel asset bubbles and distort markets. He's promised regime change at the Fed. Translation? Tighter monetary policy, less liquidity in the system, a stronger dollar. All of that is toxic for silver. Adding fuel to the fire, Republican Senator Tom Tillis announced he would block Warsh's confirmation until the Justice Department investigation into Powell is resolved. That created uncertainty about whether Warsh would even be confirmed. Markets hate uncertainty. And when markets panic, algorithmic trading takes over. High-frequency traders saw silver dropping and triggered automated sell orders. Those sell orders pushed prices lower. Lower prices triggered more sell orders. The feedback loop accelerated into a death spiral. But the Warsh nomination was just the spark. The real fuel for the fire came from the Chicago Mercantile Exchange. On January 13, 2026, the exchange announced it was raising margin requirements for silver futures. Margins represent the deposits traders must put up to cover the risk of default. When you trade futures, you're using leverage. You don't pay the full value of the contract up front. You post a percentage as collateral. The exchange raised silver margins to 9% of contract value. That might not sound like much, but here's what it meant in practice. Each COMEX silver futures contract represents 5,000 ounces of silver. At $121 per ounce, that's a contract value of $605,000. Under the old margin system, traders might have been required to post $20,000 to $25,000 per contract. Under the new 9% requirement, they suddenly needed to post $54,450 per contract. That's more than double what they had deposited, and they had to come up with that cash immediately. If you were holding 10 contracts, you suddenly owed an additional $300,000 in margin. 20 contracts, $600,000. Traders who couldn't meet the margin calls were forced to liquidate their positions. And when forced selling starts, it creates a feedback loop. Prices drop. Lower prices trigger more margin calls. More margin calls force more selling. More selling pushes prices even lower. The death spiral accelerates, but it didn't stop there. On January 30th, the day of the crash, the exchange raised margins again, this time to 9.9%. Then again on January 31st to 11%. 3 margin hikes in 3 weeks. Every hike forced more traders out of the market. Every hike pushed prices lower. And here's the brutal irony. The exchange claimed it was raising margins to ensure adequate collateral coverage due to market volatility, but the margin hikes themselves were creating the volatility. It's like throwing gasoline on a fire and claiming you're trying to put it out. Retail traders got obliterated. Hedge funds got crushed. Even institutional investors who thought they had enough capital got margin calls they couldn't meet. The entire futures market imploded, and physical silver couldn't keep up. Silver wasn't alone in the carnage. Gold crashed right alongside it. Gold had touched an all-time high of $5,600 per ounce on Thursday, January 29th. By Friday afternoon, it had plunged to $4,745. That's an $855 drop, nearly 12% in a single day. It was gold's worst intraday decline since the early 1980s. Gold and silver had enjoyed record-smashing rallies in 2025. Gold surged 66% over the course of the year. Silver exploded 135%. Both metals were behaving exactly as safe havens are supposed to. Rising alongside geopolitical tension, currency weakness, equity volatility, and record levels of government debt. Central banks were buying gold at record levels. Poland, Turkey, and India were accumulating thousands of tons. The dollar was weakening. Federal deficit spending was out of control. Everything pointed to higher precious metals prices. But by late January 2026, precious metals were no longer simply reflecting inflation hedging or geopolitical risk. They had become part of a broader momentum trade. When silver begins to outperform gold aggressively with parabolic price action, it often signals a late cycle phase of a move rather than the beginning of one. The market had become stretched, overbought, crowded. Everyone was long gold and silver. Retail investors, institutional funds, hedge funds, even pension funds were piling in. And when everyone is leaning the same way, even good assets can sell off as positions get unwound. The immediate catalyst came from big tech stocks. Microsoft shares fell more than 11% in a single session, despite reporting stronger than expected earnings. That sent shockwaves through global markets. Investors started de-risking, selling everything. taking profits, raising cash. Once gold and silver prices began to fall, market structure took over. Gold and silver markets are heavily intermediated by banks, ETFs, futures markets, and algorithmic traders. When volatility spikes, liquidity often evaporates. Market makers reduce the size at which they're willing to quote prices. Spreads widen, price gaps appear. When prices swing too far, too fast, banks and brokers step back to manage balance sheet risk. That retreat exacerbates the move, triggering stop losses, margin calls, and forced selling. The entire precious metals complex imploded in tandem. The real victims of this crash weren't the institutional investors or hedge funds. They were the retail traders, everyday people who thought they were protecting their wealth by buying silver, people who watched their life savings evaporate in 48 hours. A major silver long whale faced a full liquidation of its $29 million position on January 31st, 2026, as spot silver prices dropped below $75 per ounce. This whale suffered losses exceeding $4 million in the process. The liquidation was triggered when prices broke key support levels and stop-loss orders forced rapid selling. The impact was most severe on one trading platform where an $13 million position was fully closed in a single trade. But the whale wasn't alone. Thousands of retail investors got margin calls they couldn't meet. Many had bought silver on leverage, using borrowed money to amplify their gains. When silver was climbing from $80 to $100 to $121, that leverage made them rich on paper. But when the crash came, leverage turned into a death sentence. Here's how it worked. If you bought 10 silver futures contracts at $100 per ounce using 20% margin, you controlled $500,000 worth of silver with just $100,000 of your own money. When silver hit $121, you were up $105,000. A 105% return on your capital in just a few weeks. Life-changing money. But when silver crashed to $76, you were down $120,000 on a $100,000 investment. You didn't just lose everything, you owed money to your broker, and if you couldn't pay, your broker liquidated your position at the worst possible time, locking in catastrophic losses. Retail traders who held leveraged silver ETFs got destroyed even worse. The ProShares Ultra Silver ETF, which uses 2x leverage, crashed nearly 60% in one session. If you had $50,000 in that fund on Thursday morning, you had $20,000 by Friday afternoon. Gone. Evaporated. And there was nothing you could do about it. The phones at brokerage firms were ringing off the hook. Investors screaming at customer service reps, demanding answers, demanding refunds. But there were no refunds. The losses were real. The money was gone. And the worst part? Many of these investors were retirees trying to protect their savings from inflation. They weren't speculators. They were scared. This isn't the first time silver has crashed like this. 46 years ago, on March 27th, 1980, the same thing happened. That day became known as Silver Thursday. Back then, two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They borrowed billions of dollars and bought up massive quantities of physical silver and futures contracts. At the peak of their buying spree, they controlled roughly 2/3 of all privately held silver on Earth. Silver prices exploded from around $6 per ounce in January 1979 to $49.45 per ounce by January 1980, a 713% surge in just over a year. But the exchanges stepped in. COMEX adopted Silver Rule 7, which placed heavy restrictions on buying commodities on margin. The Hunt brothers had borrowed heavily to finance their purchases. When margin requirements spiked and prices began to fall, they couldn't meet their obligations. Silver plunged over 50% in just 4 days. The Hunt brothers faced a $1.7 billion loss. Banks had to provide a $1.1 billion emergency loan to prevent a complete financial system meltdown. The brothers eventually lost over $1 billion and were forced into bankruptcy. They were charged with conspiracy to corner the market in order to pay $134 million in compensation. The parallels to today are eerie. In 1980, the exchange raised margins to force liquidation. In 2026, the exchange raised margins to force liquidation. In 1980, leveraged speculators got wiped out. In 2026, leveraged speculators got wiped out. In 1980, the collapse happened in days. In 2026, the collapse happened in hours. The difference is speed. Technology has accelerated everything. Algorithmic trading, high-frequency systems, and automated margin calls mean crashes happen faster and harder than they did in 1980. Back then, traders had to call brokers on the phone. Today, everything is automated. Positions are liquidated in milliseconds. There's no time to think, no time to react. Just pure, relentless selling. The Hunt brothers spent a decade unwinding their losses and selling off assets. Today's retail investors won't get a decade. They're already wiped out. So what do you do after a crash like this? First, understand what just happened. This wasn't a fundamental change in silver's value. Industrial demand is still strong. Supply deficits are still real. The reasons people bought silver in the first place haven't changed. What changed was market structure. Leverage got flushed out. Speculators got liquidated. Margin requirements, forced selling. That's a technical event, not a fundamental one. Second, recognize that volatility works both ways. Silver crashed 36% in one day, but it surged 215% over the previous year. If you can't handle the downside, you have no business chasing the upside. Precious metals are volatile. They always have been. They always will be. If you're investing in silver or gold, you need a stomach of steel and a time horizon measured in years, not days. Third, never use leverage for precious metals. Ever. The people who got destroyed in this crash weren't holding physical silver in a vault. They were trading futures contracts with borrowed money. They were buying leveraged ETFs. They were gambling, not investing. If you want to own silver, buy the physical metal or a non-leveraged ETF like SLV, store it safely. Ignore the daily price swings and hold it as insurance, not speculation. Fourth, diversify. If your entire portfolio is in silver, you just lost everything. That's insane. No single asset should represent more than 10 or 15% of your portfolio, no matter how confident you are. Spread your risk across stocks, bonds, real estate, commodities, and cash. Fifth, stay informed. The economy is unraveling in real time. Consumer confidence just crashed to its lowest level since 2014. If you haven't watched our last video breaking down that collapse, go watch it right now. The recession warning signs are everywhere. This silver crash is just one symptom of a much bigger problem. Markets are fragile. Investors are panicking. And the Federal Reserve is paralyzed. The next 6 months are going to be brutal. But if you prepare now, diversify intelligently, and avoid leverage, you can survive this. The question is, will you act before the next crash hits?